So there are 5 main factors that go into the option pricing model. 5 factors. And those 5 factors are price of the underlying, timed expiration, the strike price that you are trading, the cost of carry, which is now a thing with interest rates where they are. For years and years and years, with zero interest rates, cost of carry really was just, is there a dividend? But now it matters. Cost of carry is calculated by XRT, strike times rate times time. And then we have the volatility component. Now, what volatility component does the option pricing model want to use? What kind of volatility does the option pricing model want to use? We're doing some Mark explaining here. Anybody know? Anybody? All right, what is the volatility component that goes? Scooter says IV. That is incorrect. Scooter, sorry to call you out, but most people think it's IV, and it is not. When you pull in Black-Scholes, all right, when you get your Sheldon Natenberg book, Scooter yelled HV. Nope, Delta's wrong too. So I'm going to go, and guys, this is, if you're looking for the Bible of the business, this is it. I'm going to go to Introduction to the Theoretical Pricing Model, 49, page 49. And folks, if you think that this doesn't matter, you can actually see my notes that I was going through when I was highlighting this. All right. Random walks and normal distribution. So mean and standard deviation. All right. So love that piece. The volatility, the Black-Scholes model is a continuous time model. Very important. All right. And the piece that it is using, all right, for volatility is called future volatility. Look right there, future volatility. I don't know if I need to move back a little. Future volatility. Now, I mean, you're one of the smartest people I know.
What?
Not at markets, but you're smart. All right. Can you tell me what the volatility for the stock market is going to be at in the future? Can you tell me, here's the book for everybody. Can you tell me what the price of volatility, what volatility is going to be in the future? Vic says no one can. No, you cannot. You, despite your borderline.
See, I was going to say that.
Yeah, despite your borderline omnipotence, all right, when it comes to all things, you can't tell us that. So what we do is we actually, because the Black-Scholes model is a differential equation, we take the price of the option and we solve for volatility. That is how markets trade. We take the price of the option and we solve for volatility. Get the 3rd edition. The 3rd edition is out now. Get the 3rd edition. We take the price of the option and we solve for volatility. That is implied volatility. Now, implied volatility is the market's best guess, all right, at how much we are going to move in the future based on the price of options. That is what we trade. When I'm a market maker, I am trading implied volatility like you trade a stock price. All right, now, then there's the last piece. And the last piece is historical or realized volatility. All right, realized volatility. And what that is how much we've been moving in the past. Now, past performance is not indicative of future returns, but history doesn't repeat itself, but it echoes, right? That's what people say. So what I like to do, one of the things I use to manage when I want to go long an option is how much is the stock how much has the stock been moving, and how much do the options cost? All right. How much has the stock been moving, and how much have the options cost? And take a look here. This is one of the key things that I'm always scanning for. These inflection points. Purple line is how much we've been moving. The green line is the cost of options. So if I bought put on Apple right here, a little bit off. If I bought a put on Apple right here, did I make some money? That's the crazy thing. Right now, options are cheap in Apple because Apple is moving a ton and they're not charging you a lot for options. Same thing in some of the other big names on my scan. They're begging you to buy options on Meta. Well, maybe not anymore. That is 28. So now, here we have kind of a different situation. Tighten this up. When we crossed here, if you were willing to take a leg out, you would have been able to participate in this upside, and the options would have been cheap. Now that we're up here, and we've got this cross, options are no longer cheap on Meta. This is what we're doing.